Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. After a brief lull on Friday, the markets have resumed their downslide. The Nifty trades around the 11,200 mark. All sectoral indices trade with losses. Indiabulls Housing Finance has refuted all allegations of fraud leveled against the company by Rajya Sabha MP Subramaniam Swamy. The stock, however, trades with losses of close to 10%. ICICI Bank has bucking the trend in today's trade. It is the top performer on the Nifty after a strong first quarter result. And Vodafone Idea trades with losses of close to 30% after a weak performance seen in the first quarter. Lowering of the subscriber base adds to the bearish sentiment. Good afternoon, Neeraj. Clearly not a great start to this fresh week, and I think we breached another psychological level of 11,200 today.
Yeah, and everybody was thinking that 11,300 will act as this support. Somehow has had a case of sour grapes. So it's not looking too great. Nothing ominous, but not looking great. Just the fact that on Friday's session, we thought that we might actually bounce off from those key RSI support levels and the 11,300 mark, etc. has not happened. Banks have held out predominantly. ICICI Bank and a couple of the corporate-facing banks have held, and which is why the Nifty Bank is not doing as poorly, and that is actually a bit of a respite. But we surely need the others to participate. For now, it's not happening. And autos and select other pockets are clearly bearing the brunt of selling pressure. The market is also negative. But let me quickly get in the Nifty 50 heat map and show you what's moving and what's not. The focus should be on the losers. So Indiabulls Housing Finance down 8%. Grasim is down about 8% because of the Vodafone Idea crash. 30% crash in Vodafone Idea. Grasim holds about 11-12% in Vodafone Idea. So no surprise that Grasim is doing what it is doing. And then the auto pack has been taken to the cleaners. Tata Motors, Bajaj Auto, Maruti Suzuki, Eicher Motors, almost everything is getting impacted. And mind you, Vedanta, this whole talked about deal and how it unravels and it releases the one concern that was there on the stock. Sadly, it doesn't get released. Down in Friday's session, down in today's trade as well. A lot of losers, a lot of red, save for ICICI Bank, which is holding out and helping the Nifty Bank, and to an extent IndusInd Bank. Hardly any banks as well which are holding out. Just shows the extent of pain. Remember, tomorrow the ICICI Bank gains might not be there. Very, very interesting to see how we trade in the session. Large caps under a lot of pain. I'm sure mid caps are doing no different.
Yeah, so from the peak of 12,100, Nifty's down about 7.5%, but for the mid caps and the small caps, it's even more. That much talked about reversal has just not come in for the broader market space, and the discount just keeps widening for both the large caps and the small caps, between the large caps and the small caps. I want to quickly run through some of those stocks that Neeraj was also highlighting. So starting off first with Vodafone Idea and the stock being pummeled out of shape. The stock's down closer to about 25% now after an intraday drop of 30-odd%. Which takes its total market cap to a market cap that was lower before the merger as well. So Kansai Nerolac, that one, the numbers just got reported. EBITDA was up 14%, profits rose by 5%, margins improved, and the stock's up about 5.5%. While the same cannot be said about Havells, which had a really disappointing quarter, and the result of that is on your screen. The stock's down about 4.5%. Other gainers in trade include the likes of Graphite India. Then you've got HEG, which is doing well, about 4% on Friday's session. Graphite, HEG, and Philips Carbon Black, all three names were up in the heavily in the green. Praj Industries was also up post its numbers, and from there it's put on marginal gains. So today's session also another 2.5%. Big losers, Indiabulls, the entire group. So not just Indiabulls Housing, Indiabulls Real Estate, Indiabulls Ventures. Even though the management clarification has come in, that's really not helped any of these stocks. And Lakshmi Vilas Bank also being pulled into yet another tweet controversy, and that one too is down about 8-odd%. Volume buzzers, Granules India for one, that's up on good volumes, and so is VST Industries. 4% higher, volumes much higher than the last 20 days average. Quickly then on to the futures and options space and how we are set up for the second day of the new series, rather first day of the week. Navneet is setting that up for us.
Hi Devina, thanks for that. Well, clearly it's not been a great start to this August series as well, and unwinding continues, at least that was seen on day one. But today you are seeing some bit of addition when it comes to Nifty futures open interest. But remember, premium has come off from levels of 40 23 to 17. So that tells you at every rebound there is fresh supply coming in into the markets. For Bank Nifty futures, Bank Nifty, remember, because of ICICI Bank, which has nearly 6% weightage on Nifty and also heavy weight on Bank Nifty, has been lending some bit of support. So 10% higher when it comes to the open interest there. But the premium on both Nifty and Bank Nifty futures have come off. And clearly, volatility seems to be on the upside today. India Volatility Index has crossed the level of 13. That's up about 7.5. It's still not at very elevated levels, but considering the spurt that you're seeing in today's session, clearly says that the bears are in full control of the market. What sort of levels then you should watch out for August 1st expiry? The maximum open interest on the call side has now moved from levels of 11,400 to 300, and on the put side, of course, it is still sitting at 11,200. But two key data points the base has moved lower after we breached the 11,200 mark, because the put writers of that strike are running for cover. There is unwinding of nearly 4 to 5 lakh shares seen at that strike, though Nifty is still defending that mark of 11,150 for the day. So the range remains very, very narrow, 11,150 to about 250 on the upside. Very quickly, some 3 stock futures I want to highlight, and we've been talking about how ICICI Bank has been lending support both to Nifty and Bank Nifty. The numbers were good, but important to watch out, the stock's gone up on very good volumes in the cash side, and if you look at the data very closely, almost 50% of the traded quantity as of now is marked for delivery on National Stock Exchange. So that's telling you there is cash-based buying, which is a positive sign for ICICI Bank. However, on the future side, I've not seen any major spot coming in with regard to the OI, so that's just about 4 to 5% higher. The other one is Indiabulls Housing, the top loser on Nifty. Despite of clarification coming in from the management, no respite here. Fresh shots continue. The stock's trading below all key moving averages. And earnings reaction coming in from Havells. It's a miss on all parameters. In fact, right from the word go in the morning, you did see short positions building in for this counter. And it's been an underperformer. It's down almost 15% for the month of July. And the fall today has come in very high volumes in the cash side. As you can see on the screen, the volumes are very, very high compared to the average volume for the last 20 trading sessions.
It'll be interesting to see what happens in the course of the next few days, because tomorrow, as we said, we won't have ICICI Bank, and today with the newspaper headlines talking about how there might be a reversal in the stance on the FPIs, the mood might have looked slightly better. It's clearly not looking like that. So that's the bit of a pickle that we are in. Jonathan Schiessl, fund manager at IIFL Asset Management, joins us right now on the show with his thoughts. Jonathan, good having you. Thanks much for joining in. There is presumably some rethink, or at least some years which will be lent to the FPI community when it comes to the taxation that came about in the budget. This month of July has seen incessant selling from the FPIs. You would be a good gauge of what's happening in that community with regards to view to India and how you yourself are viewing investments in India right now. What's your sense if that does turn around a bit? Does it turn the sentiment, or the slowing economy is the principal reason and this selling would continue?
Good morning and hi. I think it's a bit of a mixture of everything, really. I think clearly there was expectations for the budget, which, for whatever reason, haven't been met. Then obviously the continual tinkering with taxes and stuff doesn't clearly doesn't help from an FPI perspective. But probably most importantly, quite frankly, is India still trades at a decent premium to other emerging markets. I think this growth slowdown is clearly leaving some questions in some foreign investors' minds about why we should pay such a large premium over other emerging markets, when the economy clearly has been slowing down, and earnings, we're still waiting for this long fabled earnings recovery.
Your clients, Jonathan, talking about, or people that you speak to, are they talking about, you yourself, are you talking about thinking of investing in other Asia Pacific markets over India currently? Considering that India, of course, is no longer at that 19 times valuations, and even though at a premium, but at a slightly lesser premium, maybe 16.5, 17 currently, after the fall that we've seen.
Yeah, I think that's a fair point. The premium certainly has contracted substantially. I think, clearly what's concerning investors, if you look at developed markets versus emerging markets, then the trade story goes on. China had obviously come off. It's settled down a bit at the moment. That's going to impact sentiment massively in the whole EM complex. I don't think, in reality, I think most investors probably, with the continuing outperformance of developed markets, of the US in particular, we've seen little tentacles coming out into emerging markets, but we haven't seen the big movement yet. There was obviously some buying of India a few months back with around that election and just before the election. We've seen a little bit of money coming out, but if you look historically at prior periods of FPIs pulling money out, this isn't a particularly large scale correction that we've seen just yet. So it could go on a little longer unless we either see some sort of improvement in sentiment overall in the emerging markets complex, or we see something that might surprise coming out of India, be it a larger rate cut than expected or something from government.
Jonathan, up until now, we've seen a lot of money being poured into, the high-quality consumer finance businesses. And according to most brokerages, global brokerages now, it looks like that the boom in the consumer finance space in India particularly has started to peak. Is that a view that you share too?
Not really. I think it's very interesting how quickly sentiment changes, and you see all these very negative reports coming out about certain sectors that have been obviously fast growing. Perhaps we're sort of pushing up near the top of the cycle in this area, but I think it's a cycle that can last a lot longer. It has been noteworthy that even some of the quality consumer finance plays. And the guys who are lending in that space as well, that the really good quality names have been warning about certain pockets of stress. So I think there is undoubtedly stress, but I'm not quite sure I would sort of concur with the very bearish views that some have out there on the space.
Then that leads me to my next question, which is in conjunction to the previous one, and that's obviously the auto pack. And while we're talking about consumption as a space, this discretionary pocket, which has been bogged down up until now, quarter after quarter, since the last three quarters at least, no signs of recovery, and the government is really not doing much in order to spur immediate demand. You have a good coverage on some of these bigger auto names. What would you do now?
Well, we've been, I guess, suffering a bit of pain with some of the stocks there. I think value as a style globally hasn't been working for some time. And I guess if you look at the Indian market, value as a style hasn't traditionally worked. But there's certainly some value to be found in these auto names. Yes, they're going through a pretty tough patch. But, I think we're certainly sticking with our positions. We were sort of, just taking the hit as such in the short term. We do believe, though, that these companies will come out the other side. There's some fantastic companies with excellent products, but clearly, the growth slowdown that we're seeing is being most felt in that auto and two-wheeler space. So, we will come out the other side, and at the end of the day, as investors, one of the few things we can control is the price we're willing to pay for a stock, and clearly there is good value in some of these auto stocks at the moment, but who knows when they're going to bottom out.
Hi, Jonathan. You were mentioning about the premium valuations that India trades as, compared to the other emerging market peers. And of course, we are still at premium valuations, though Nifty could have come off from 19 times to 17 times now. Do you see more downside from current levels for somebody to deploy fresh money into the markets? And I'm talking from FPI standpoint right now, because there were some reports indicating how China is now opening up, to the FI community, and we could see shift of money flowing from the Indian markets to Chinese markets.
Yeah, so I guess and it's an argument I've used many times with investors. Why first of all, we've got to understand why India trades at this premium valuation. Have we seen other markets trading at those sort of premium valuations in the past? And certainly there has been periods where other markets have traded at these very high premium sort of valuation versus EM peers. I guess India has consistently done it for a very long time. I would say that the reasons for that are still there, with India and the quality of companies that you can find. So the reasons are still there, but it's one that certainly when I speak to potential investors into India, it's one of the biggest hurdles that we certainly have to face is explaining this valuation premium that investors have to pay to get into India versus other emerging markets. So it is an issue, it is something that we have to do. I do believe, however, that India, in certain segments does deserve to trade at a premium to other emerging markets. And really, from a personal view, it's mainly down to the quality of this type of corporates that we can access, we would struggle to access in other emerging markets of a similar quality corporate. So I think the premium valuation is justified, but it's certainly one which puts a lot of investors off. There's no doubt about that. And I think when you also consider that a lot of big foreign investors are probably quite underweight emerging markets generally, it's still a relatively small part of the portfolio. India is an even smaller part, within that as well. So, yeah, it's. I think at the moment the China side probably and the whole trade issue still dominates sentiment, and that's probably going to be the biggest factor to look for. And then if you do get a resolution, you will probably see the Chinese indices doing quite well in the short term. But the last point I'd make on this one is India has underperformed global markets now, or developed markets, if you like, for the last 2 months. So some of this is being corrected anyway, this overvaluation.
It goes without saying, Jonathan, we're down almost 5% since the union budget, and US markets have been trading at their all-time high levels. Appreciate you joining us today and giving us your thoughts on the emerging markets, and particularly for India. All right, that's the view coming in from the FII community. Remember, there has been an outflow of almost $2 billion from the FII community in the month of July. This is the biggest outflow that we've seen, at least for this calendar year. Let's move on. Markets are still trading around the mark of 11,200 and address some earnings. It was a weak first quarter for Supreme Industries, with the company missing estimates on the operational front. Well, only the company's plastic piping products business saw a jump of about 20% on the top line compared to last year. But let's get a better sense on how the entire quarter panned out. We are joined by Mr. S.J. Taparia, who is the Executive Director of the company. Hi, Mr. Taparia. Good afternoon to you, and thanks a lot for joining us today. Though the revenues from the plastic business may have gone up by almost 20%. I was just looking at the EBIT margins. They've declined not only on year-on-year basis, but also sequentially, coming in at 8.7%. Could you tell us what was the reason for the decline in margins? Were there pricing pressures also felt? And also take us through the main highlights of the quarter gone by.
See, the quarter gone by, we have grown by 8% on the value terms, where in the volume terms we have grown by 14%. The reason for lower operating profit has been declining in the polymer prices, as well as big agriculture demand for our pipes, which is a low value added item. That's the reason for lower profit. For the last quarter, our operating profit has been 167 crores against 186 crores of the previous quarter. But all in all, we feel the year will be good. We expect to grow at the rate of 8 to 10% in terms of volume, and in value terms, we hope to grow by 12 to 15%. Okay. Operating margin this quarter has been 11.62%, which we hope to get 13.5 to 14.5% for the year. We expect good demand in plastic pipes, especially with the various schemes announced by the government. And barring some sector, our other sectors are doing well. We are definitely affected by the slowness in auto and other consumer durables also, but they are much better in comparison to auto. But all the other divisions will show a reasonable growth, and we hope to achieve a turnover of around 6,000 to 6,200 crores for the year.
Okay, so you're suggesting for the year, company is targeting to clock a turnover of 6,200 crore, and on the margins front, which came in at 11.7, you expect them to normalize back to levels of about 13.5%. Just a word on the prices you just highlighted, which impacted the EBIT performance of your plastic business. You said that polymer prices have been going lower. Could you just tell us what was the quantum of the prices which went down, and do you see this trend continuing even in the coming quarters?
See, like in polyethylene, the prices in this quarter has come down by almost 12 to 13%. Now prices have reached its rock bottom, that's what we believe, and they may move in the target range. We expect the plastic prices to remain affordable in the remaining period, and that's the reason for we should grow well, because reasonable prices of plastic raw material always keeps better demand for the products. Company is going ahead with its capex plan, which is to the tune of 300 to 350 crores, and mainly our expansion will come in piping division or related products. We are expanding our piping system in Kharagpur, in Kanpur, and Jarchalla will start a new unit for making plastic pipes and some specialized fittings.
Okay.
So all in all, we expect it to be a reasonable year, having a growth of 10%.
Okay. So, since you already spoke about prices coming off, what kind of an impact did they have on inventories? And did you see a bigger loss? Because I think the inventory loss is continuing to bother you since the last quarter.
Yeah, that's right. Last quarter also we had major loss in inventory in PVC, and this quarter it has been in polyethylene. Plus, you always keep inventory, so there is a loss of inventory. But now, as we believe that the further inventory losses should not come because the prices are stable, and they should remain range bound.
Okay, and if not go up, you probably the next quarter onwards, inventory losses should not affect margins, according to you.
Yeah, as it looks.
Okay, volume, sir. Would you expect around 10% for the year?
What? See, volume, yeah, we expect to grow by 10%.
Okay, so this time around, the overall demand scenario, your volume has been between 7 to 8%, would you say?
No, this quarter we had grown volume by 14%, okay, from 99,000 tons to almost 113,000 tons.
Expecting the rest of the year to be
of
slower?
Products which we sold in the first quarter.
So you're expecting the rest of the year to be slower?
Well, it is mainly this quarter the volume growth more because, as I said, in the huge demand in agri pipes, which was quite good compared to all the few previous years. So that's the reason for main growth in the volume.
Okay, just one last question with regards to the packaging business, sir. Last quarter you said that there were headwinds from competition. How have you tackled that this quarter?
This quarter also has been tough, as I said that the major inventory loss has come in this sector because of drop in polyethylene prices, and which now should remain stable. Our other except film also this quarter has not been all that good, but for the future we expect to be better with better product distribution, new introduction of new products. So this division also, this vertical also will do well.
Sir, just a last question. Would you look to tweak your product mix? I think most of the companies are working towards that in order to combat the slowdown that one has seen in the auto space.
No, slowdown is in the auto industry. Our other, wherever need-based expansions required, which we are doing, and except auto, appliances division is doing reasonably well, and they expect to do better. But other than that, all the other furniture demand or all the other product groups, they are doing reasonably well.
Okay, sir. We'll leave it at that note. Appreciate you joining us today and taking us through the quarter gone by. That's the management of Supreme Industries, highlighting what stood out for them in the quarter gone by. 13 to 14% volume growth, but the guidance for FY20 is in the range of about 8 to 10%, and they've said that they are targeting to clock total turnover of about 6,200 crore. The stock's down, by the way, over 2% at 1,075. Let's move on and talk about Vedanta, which expects to end the year on a strong note despite missing estimates in Q1. In an address to investors, CEO Srinivas says prudence will be exercised, relying on cash flows rather than debt to fund growth projects. He began his address with the company's rationale behind pulling out investments from Anglo-American. Listen in.
You would have seen from today's announcement that both Vulcan and Vedanta have unwound their respective transactions. So we do not have any interest in the underlying shares of Anglo-American anymore. If you recall, we entered into this transaction in structured investment for superior gains. We have gained around $100 million in the 8 months when we have had the investment. Importantly, all of the gains that have accrued on this investment have been passed across fully to Vedanta Limited's shareholders. And I think that's quite something which our shareholders have been very positive about. If you look at our results, despite weakening commodity basket, our operational results have been very strong. In fact, we have had volume growth across some of our key verticals, and the aluminum costs have been reducing quarter on quarter, and we are getting closer to our target of $1,500 a ton. In addition to that, we are investing around 10,000 crores on expansion projects this year, and that is progressing well. Silver in particular grew by about 15%. We are now number 9 silver producer in the world, very soon to become number 2 silver producer in the world. Looking at our guidance for the year, if I can point out, guidance takes into account 10 to 20% growth across all of our commodities and a 10% to 15% drop in our aluminum costs. All of those are on track, and we are confident that we'll have a good strong finish to the year, especially the second half of the year. In terms of our growth projects, they're all on track. If you recall, we said that we are spending around 50 to 60,000 crores in terms of the medium term to basically increase our production and volume by about 50% across all of the commodities. That is also on track, and that would actually change the group completely, particularly given that India is opening up under its new minerals policy and also under its OLAP, and we are excited hugely with the opportunity which the new OLAP blocks offer for Vedanta. Turning to the balance sheet, a strong balance sheet. Net debt to EBITDA is around just over 1 times, which is industry leading in this regard, and we continue to maintain strict focus on capital discipline. Businesses have to earn their margins and their cash flow to get the right to spend on capital. So overall, prospects for the group look strong, both in the short, medium, and long term.
All right, that's the CEO at Vedanta, not doing much for the stock. Friday's session was down heavily, and in today's trade too, the stock's down about 4.5% at the lowest point of the day, 156 on Vedanta. Moving away from that, then the government has lowered taxes on electric vehicles and intends to fast track the implementation of the scrappage policy. But can these measures revive India's failing auto sector? Earlier today, we put these questions to Maruti's former managing director, Jagdish Khattar, and SBI Capital's Chirag Jain. Yatin Mota, who moderated the discussion, joins us now with the key takeaways of that entire conversation and what came out of it, Yatin.
Afternoon, Devina, and the discussion primarily was done to assess exactly what is the issue with regards to GST on the entire auto sector, including the GST cut which came in on electric vehicles. Jagdish Khattar, who is the industry expert, of course, he was the former CMD at Maruti Suzuki. He told us specifically that the problem has moved beyond GST cut. As far as the Indian auto sector is concerned, the government needs to do a lot of other measures as well when it comes to demand revival for the auto sector. More importantly, also pointed out the issue with the electric vehicle segment. He said that the auto companies have invested crores and crores of rupees as far as the traditional ICE engines are concerned. And it is not that easy for the electric vehicle segment to disrupt the entire industry. So the pickup in electric vehicles and the ramp up thereabout would not be as sharp as the market is anticipating in the short to medium term. And that is what he said, that the sales for electric vehicles to probably come to a commendable size would take time. On the other hand, we also spoke to SBI Cap's auto analyst Chirag Jain, and he also was talking about the uncertain demand environment that the managements have been speaking about in the recent conference call post the earnings. He also pointed out, though, that the electric vehicle segment, which has seen tax cuts from 12% GST to 5% now, there we could see some significant disruption in the two-wheeler space, because there are a lot of products and companies which are coming in the two-wheeler segment, and that is one particular segment where we could see some disruption happen in the medium term. More importantly, Chirag also mentioned the fact that as far as the scrappage policy is concerned, there was a big disappointment there, especially with the commercial vehicle segment. Earlier, the government did propose some fiscal incentives, and that is something which was missing in the proposal, which was given by the Ministry of Roads and Transportation. So on all across the segment, be it the scrappage policy, hike in registration fee which has been proposed, or the tax cuts in electric vehicles, hardly all of these factors would help revival in the auto sector, which was earlier anticipated by the market, and probably that is the reason why we are looking at a 3 to 4% average cut which has come in for most of these auto companies. And remember, the auto index is already at a 3-year low. Let's listen into what Chirag Jain of SBI Cap had to tell us during the discussion that we had earlier in the day.
As far as the general outlook is concerned, definitely we had now few results and few earnings con call from the likes of TVS, Bajaj, Maruti. By and large, the view is fairly uniform that consumer sentiments are quite weak. Not just because of the regulatory changes which are happening in the auto space, but also in general because of the weaker economy. And as of now, there doesn't seem to be any major catalyst or sort of any signs of recovery, which, let's say, the companies have highlighted. So in a way, there is a lot of uncertainty over the next few quarters as specifically as we enter into BS6 transition, which would probably happen in third and fourth quarter of this financial year. So yes, sort of a disappointment. One, obviously, the registration fees have gone up. Second, the scrappage policy is very diluted in its proposal, in its current form. And obviously, the underlying sentiments are quite weak with no major signs of recovery, at least for the time being.
All right, and that opinion has pretty much resonated by industries as well, the industry key people. R.C. Bharuka, chairman of Maruti Suzuki, said the increase in registration hasn't happened for a long time, so that is not an issue. The issue is the timing of the increase when the industry is anyways facing several challenges. Any increase in costs will impact demand negatively. So the timing is the problem, and that's what is the issue for most, because anyways the industry is facing various headwinds and challenges, and this is an added cost which is going to dampen demand. But let's get into our market conversation now. Hemen Kapadia of KRChoksey, he's joining us on the show. Along with him, Karla of Target Investing is also here with us on the show. Hemen, starting off with you first on the Nifty. Intraday breach is under 11,200 now.
Well, frankly speaking, that's a cause for concern, no doubt, but Devina, rollovers have been very tepid. And we saw 2.5 lakh reduction in OI on Friday. I mean, such low volume, I'm not sure if one tends to take this very seriously. And the Bank Nifty has not broken the low, so obviously it doesn't look good. I mean, there's no soft peddling it, but I still feel that market could look at the setup for some sort of a bounce, however unsustainable it may be. So a buy on Balkrishna at 718, stop loss 710, target 734. And I have a contra buy on Tata Steel at 435, stop loss 428, target 449. And as far as the Nifty is concerned, Devina, a plain vanilla buy call at 70, 11,400 call, stop loss 60, target 90. Devina.
Okay, so those are, that's the Nifty call given by Hemen. He's suggesting to buy the 11,000. Is that for the current weekly series?
Oh, no,
that's
monthly.
a monthly. Okay, so he's suggesting to buy the monthly one. I think that expires on 29th August or somewhere, to buy the 11,400 call. And he's got two stock picks, and those are buy calls, buy on Balkrishna and Tata Steel, right?
Steel, yep.
Okay. Hi, Samir. Good afternoon.
Good afternoon.
Selling pressure continues. We've seen outflow of $2 billion now from FIIs, and I think this month was the worst for this calendar year. Do you see this selling continuing, or now one should use this as an opportunity for bottom fishing?
No, I think this opportunity, any kind of bounces from here on, maybe even a 200, 300 kind of a bounce, should be used to sell out. because I don't see any respite for next 6 months.
Okay.
Because now when you see the decision taken on the auto industry, see what people forget, that auto industry has a ripple effect in India. At least 20 or 25% of the whole GDP system is connected to autos directly or indirectly. And if that gets dragged out very drastically, which it will on the festival season now, then the whole problem gets stretched to the second phase, where I see maybe even a further downside on the Nifty and stocks involved, and maybe January or Feb onwards I see some kind of respite.
So
Nothing before.
You do expect Nifty to breach those key levels now of 11,000?
Yeah, so I was waiting the moment it went 11,600 and this whole news built up was there. I was waiting for 11,175 to come, fill the gap and then come over here. Now I feel 10,900 or 10,600 isn't far the way we are going. Because even if you see today some kind of a respite, or at least coming on the table, came from FM regarding the FIIs. But I think it's too late now.
She's just willing to have a dialogue now, and clearly
it's too late. And see, the whole point is that trust issue has become very hard right now, and people will not let go any kind of a space where they get into that belief and come back.
Correct.
So I think even the ground data is very different, and they're putting more pressure on the present to see that next 5 years as a 5 trillion economy from my point of view.
Okay, 10,600, that's... all right, we'll see when we get there. But it's quite a bearish picture. But nonetheless, even a drop of 7.5% right now, considering it's happened in a more staggered fashion, it's given time for investors to digest this kind of a move. Anything swifter than that would have had bigger repercussions. Talking about a few stocks, and I have to bring up Vodafone Idea, which is today's worst performer. On Friday's session itself, it went below face value after pasting. Right now at about 6.9. I mean, what's happened to this? I mean, are we to assume that now from a 3-player industry is going to become a 2-player industry?
See, that's where I'm kind of getting zonked, that if you see, on the ground, they still have the highest subscribers, right? Now they've edge to edge with Jio, but they still have. The only problem they're facing, one is the debt part, which they are not able to reduce as per the expectations of the company and the management and the analyst community. So that is a major problem. Secondly, they are not able to arrest the monthly falls in the subscription numbers. So if they are able to address this till that time, I don't see any limit on the fall, at least from here. So I think, but I don't see any reason to sell out now. Because if you already had from 2020,
what's more to lose?
Yeah, that's what I'm saying. So I don't see any repercussions of you selling out here and then seeing a reversal at 4 rupees or 5 rupees, wherever it ends up getting reversed. But I think it's better to hold on now and then later on see how the position comes.
This technically means Vodafone has come free now, considering the market cap at which it's currently trading is below the market cap it was before.
But that's where I'm not able to understand what's driving this kind of fall in the price. See, market cap is somewhere given after a while, it's given to at least a EBITDA versus market cap. Over here, it's not even going towards that kind of level. So I think there is a disconnect, and especially if it's in derivatives.
No, but what's the road ahead? Because Jio will continue to, keep prices low at least for the next few years in order to let the peers continue to bleed the way they have.
But the only point is, if you see the numbers, ARPU has increased. So ARPU increase is benefiting the EBITDA level. But what is happening? Your depreciation, because on the fiber assets.
Yeah, the larger picture is the money which they had raised, 25,000 crore. I think that's going to get over in June 2020.
Yeah, but the only point is then you're assuming that there's no asset sale.
Capital,
You're saying that there's no asset sale going on, there's no merger with Bharati Infratel. So we are assuming that point. So that's what I'm saying. So if right now you assume that things and that June 2020 is, let's say, an end date for Vodafone as we know it. But the only point is, if I sell off right now, what do I get?
Yep, right now, only you'll be booking losses.
My motive is to better hold on, see the situation drag out. You've seen from 25, at least from 25, 30 levels to 6. So if you've seen that fall, I don't see any sense of selling it out right now.
It's too soon to say whether this could be a takeover target or no, because that's what's been happening to some of these really beaten down companies.
See, the only point is who will take over the debt levels which you have. The debt levels are too high.
When the other two are already struggling to reduce their own debt.
So even I think that's why I feel somehow even Bharti Airtel is kind of overpriced as of now. If you see, the situation is not that better. They are trying to plan it out, but it's not going as per plan either for Bharti Airtel or Vodafone.
Yep. All right, Ashish Kelkar of Kiran, Jadhav and Associates is also joining us on the show. Ashish, a very good afternoon to you. Let's start talking about your call on the index. What would it be? What kind of a trade would you take? And you could probably run us through your stock ideas in the same go.
Yes, good afternoon, everyone. About Nifty, we can see there is a selling pressure, and we have recommended a sell signal in the morning to all of our clients. The important level for the Nifty was 11,210. Once this level was taken off, immediately we have seen the fall of around 50 to 60 points. So now we are
we'll just cut back to Ashish in a few moments because his audio is a bit weak currently. I just want to, come to you, Hemen, and then I'll get your view as well. Indiabulls housing, while the fundamental aspect and the news that's driving down the stocks today, keeping that aside, any technical levels that it has triggered that you would further sell any of these names? Real estate, housing finance, ventures? Because ventures had run up a lot initially in the last 1 month or so.
Well, if you start with Indiabulls Housing Finance, Devina, I think we're clutching at straws. 550 has been important. We might have breached it sometime or the other, but we haven't closed below this level for ages, Devina. So one gets the feeling that we're at crucial levels and we've not closed below this since, I think, June 15. So it's been 4 years now. And we're threatening to do that, and we spent almost 8.5 months moving sideways. So on the hindsight, if this breaks 550, this whole thing was the distribution, and we'll probably gravitate towards sub 400 levels. That bad it can get. And the other Indiabulls that you're talking about, I think they all, they all seem to be in a, they're already getting hammered, frankly speaking. Not much to look at. The way I see it, but yeah, Indiabulls ventures, okay, that's not, if you got support at 240, but housing finance is crucial, Devina. Below this 50 level, I think we're going to implode actually.
Samir, your take on this whole issue?
So I think this is the second time in quick succession that same kind of allegations are going on, and somewhere the company still is giving that same kind of
clarification,
stance, right? So I think there has to be something where two people different ends, or either they were the same ends. And now if government steps in, this is something which I think a long-term investor really don't want to hold on to. And irrespective, if you see the business also, I think raising money is becoming an issue for them, at least in the commercial paper markets and the NCDs.
But there's still a lot of cash on their books.
See, the only
and the
point
management has always been touting that only and harping on the fact that, we've always made payments on time, we have so much of cash on our books.
But see, there's a difference between a cash flow on books and free cash flow on the books. How much cash flow and free cash flow comes for a finance company, that differs a lot.
These are not long-term assets that they're talking about. This is free cash flow only that they've been talking about.
No, but the only point is that cash flow right now, if you're doing a dispersal of that 15-20%, that cash flow doesn't last for 2 to 3 months. It's just that you have to sacrifice the dispersals, like a lot of NBFCs are doing. And now raising even the NCD which they were raising, that took more time than they expected, and even they were able to raise only half of what they wanted to. So I think over there's a stress on the group in terms of fundraising, and I think this will just further accelerate the downside from my point of view.
Okay, that's about the Indiabulls group clearly refuting the charges made by Rajya Sabha MP Subramaniam Swamy. Interestingly, that letter was written on June 28th, and now everyone's been talking about it, and you got the clarification coming up yesterday or today from the management. Samir, you briefly mentioned about the auto pack in your opening remarks for the markets. Huge sell-off seen for the auto pack, some developments coming over the weekend, how registration fees has been increased, and you're also incentivizing the EV space, whereas the sector was looking for some bit of support, by reducing the GST, but it's come for EV vehicles where infrastructure is still not very ready. Slowdown is evident. Company like Maruti comes up and says, we cannot give you a guidance right now. And earlier they used to give guidance every quarter. What have you made of the entire slowdown? Will this continue? Because Maruti also stated that because of higher BS6 cost now, that's hurting the margins, which will continue. I'm sure they have the power to pass on that cost, but again, that's going to hurt the sales. So what should one do who's sitting with exposure to auto companies? Because now it seems like more of a structural issue with the sector.
So I think in December we were talking about the same thing, and when we came to March and April, we realized this seasonal issue will be much more harder than what people expect. So see, it's always better to get out when the structural issue is there. See, I think from my point of view, whatever I'm reading from the managements, they have no clue what's actually driving this systematic fall off. It's just that you had a very 2 good years and 3 good years of 20% or 15% kind of a registration growth, wholesale growth, and capacities were added, dealers were added. Now it's somewhere rationalizing with the sense of financing. So when the financing ball took off from the dealer level, the whole industry as such is now falling apart. And government is really not helping the system. They are just pushing down the present to see something which better is as an environmental. But the only point is the industry, I don't see any reasons to buy right now or hold on to stocks which I have. I see a further downside coming because what is happening that everyone's pinning the hope on August and September sales for the festival season that they'll help revive the whole system. But I haven't seen any marks which can show that kind of an uptick. So I see sequential growth negative growth accelerating, and plus giving more pressure to the wholesale. See what is happening if you see their balance sheets, March 19 balance sheets for everyone. Their trade receivables have gone up 40%. So that means you're holding on to cash and you're giving higher credit as well to dealers and you're pushing your system. Now the only point is if in the next 6 months that doesn't come through and the dealers start defaulting, then who will bear the pain?
Has that already started or no?
That has started to a certain extent because it's smaller dealers which are facing the pain at the system right now. So they are able to cover up on the system. But the only point is your cash books are now going on to your receivable books. So that becomes dangerous for our valuations as such.
Okay, very quickly, a technical view. Hemen, any of the auto company would pick up at current levels?
No, I think I'd wait for some more ridiculous levels to come to.
Okay.
Maybe if that means a quarter or two more, yes. For example, if you have to look at Ashok Leyland, 64 and 58 are two levels I'd look for.
All right, we'll come back and discuss more on that, but keeping earnings in mind, Kansai Nerolac posted a good set of numbers in the first quarter of FY20. With the company's revenues rising 9% and profit rising by 5%. Mr. H.M. Bharuka, the MD of the company, he's joining us to take us through the Q1 earnings. Mr. Bharuka, thanks very much for taking out the time. Give us the highlights of the quarter. Well, we know the numbers. Are you content with them? A profit jump of about 5-odd%. EBITDA has grown about 14-odd%. You've managed to expand margins as well. Give us some key takeaways from the quarter.
So as you know, Nerolac is highly exposed to the auto segment, and our actually strategy comes from the auto segment. And unfortunately for us, auto has not been doing well. So given this situation, if you look at our number where we have been able to expand both top line and bottom line, of course we are content with the numbers. Quite happy with what we have given so far. And fortunately for us, decorative has done well, and when the auto was not doing well, the other industrial area, which is powder coating and the niche segment of the general industrial and performance coating where we concentrated, has also given us a result. So overall we could grow our top line And as far as bottom line is concerned, raw material cost of course has been under pressure. Even last year we could not pass on the entire increase to our industrial customer. However, we concentrated on the cost reduction. So if you look at our overhead, which has gone down by 100 basis point. So both the combination of top line growth and the control on overhead resulted in a good bottom line as well.
So Mr. Bharuka, going forward and the upcoming quarters, obviously the pain in the auto industry is not anticipated to go away anytime soon. What is it that you are going to undertake in terms of the kind of launches that you anticipate to make in terms of new products, which you've already done in FY19, that can overcome the space that has been left in the industrial paint segment?
So as I mentioned, I don't think we are going to do anything differently what we have been doing so far, and the first quarter is reflection of that. At the same time, let us be conscious of that. As I mentioned, auto constitutes almost 30 to 35% of our overall portfolio. And with the kind of demand destruction which we are seeing, we will never be able to compensate the entire loss on the auto segment. So we will continue to work on the decorative segment as well as the niche segment. At the same time, we are also looking that auto segment would revive and it will contribute to our growth. However, as you mentioned, perhaps next with the pain still remains, and maybe about quarter or 2 quarters, perhaps we would see this situation continuing.
In light of that, the strategy of inorganic growth that you had adopted in the previous few years, where you've gone in to acquire rack paints, you've gone in to acquire Marpol, is that a strategy that you feel that will work for you in this period where probably organic growth, which comes from few of these segments, can be a little bit tempered?
So if you look at our acquisition, those have been strategic acquisitions. Rack Paint was acquired in Bangladesh, which has done extremely well. If you look at first quarter growth of Rack Paint, it is more than 50%. So Bangladesh has been a story for us. The company which was in loss, we have turned around and made it to a profitable company. If you look at our Nepal acquisition in 2012, which is doing extremely well, there also we are having more than 25% growth and one of the most profitable company. And Marpol acquisition, which was a local acquisition, was also a loss-making company. That company also has turned around and the top line growth is good. At the same time, company has started making profit. So we acquired another construction chemical company, Parma, in the first quarter of this year. And perhaps as we progress, as the company comes into our fold fully, perhaps we should do well there as well. And we have also acquired have a JV on the adhesive chemical with Polygel, and we hope to do that also well. So our strategy of inorganic growth has been into the niche segment in India, also acquiring companies outside India, wherever we, nearby countries where the Nerolac name is very well known. I think that should continue.
Okay. Sir, the performance from the decorative segment, which is compensated, for the slowdown that one has seen in the automotive space. What was the volume growth during the quarter, and do you expect the sort of performance that you've posted in the decorative segment, can that sustain now, and can that continue to compensate for the slowdown that one has seen in the other segment?
So decorative volume and value growth has been higher double-digit growth, and decorative segment has been doing well for last about 27-28 years, and the penetration level is still low. So we expect decorative business to continue to have a double-digit growth. There could be a quarter, there could be a time when there could be some slight, less growth than what we are anticipating. But even if you look at 2008, when there was a Lehman crisis, this was the only perhaps industry which was doing well. So I see no reason for next 10 to 15 or 20 years perhaps decorative segment doing well, despite real estate not doing well.
Okay, so you're suggesting that the high double-digit volume growth will continue for the remainder of the year as well?
I think so. Decorative should continue to do well.
And what's the outlook on prices? Because you said there was value growth also seen in this space. So are you tweaking prices? How did the realizations pan out in the quarter gone by?
So realization as far as decorative is concerned, profitability has been maintained. In fact, we have reduced the prices. A small price reduction has been passed on to our customers in the first quarter. However, when it comes to industrial, last year we saw tremendous increase in the cost, and we could not pass on to our customers fully. And we expected that, we hope that we would be able to pass on in the current year. However, we are also conscious that our customers are not doing well, because you see in the entire segment of auto where they are having a double-digit volume degrowth. So we are conscious of that also, but given a choice, we would obviously would like to get margin back. But at the same time, we will not be in a position to press our customer looking at the situation what they are in. So we don't look at quarter-on-quarter numbers. We look at overall relationship. We are a 100-year-old company, and we hope that we would continue to do well in going forward.
So you've completed the construction of your new facility in Amritsar. When does that go on stream? When do you see them starting to contribute to the numbers? And also, the industrial coating plant in Gujarat, are the numbers already visible in this quarter's results?
So industrial coating plant in Gujarat has already started contributing. We have started utilizing the capacity. Almost 30 to 35% utilization has already taken place. And as far as Amritsar is concerned, by first week of September or by second week of September, we would go on stream. So in any case, we were under strain as far as capacity utilization was concerned. So with these two addition, I think it would take care of our requirement.
All right, and just one last question with regards to your working capital cycle from FY18 to FY19. It went up substantially from 74 days to 106 days. Is it still elevated, or you've managed to bring that down?
I think you are looking at the March end numbers, and if you look at the balance sheet numbers, this is what you would realize. But April is always a good month for industry. So always there is a stocking which takes place in the month of March. So from that perspective, you are seeing an increase in the working capital. Otherwise, our working capital is entirely under control. All our receivables, inventory, everything is under control as per the norms.
Okay. Mr. Bharuka, we'll leave it at that. Thank you so very much for joining us this afternoon with the numbers. Kansai Nerolac, they're posting a good enough quarter. The stock is up about 5.5%. So
just wanted to take view on this one. Samir, the trend is same what Asian Paints posted and what Kansai Nerolac, and we'll wait for Berger Paints result to come by. But do you really think the growth that they're posting, both the players in decorative segment, can that last for the remainder of the year?
So I think, as they said, that April is a good month for them, and then there's a spillover in May as well. So Q1 is always good for them, but even if they are showing a double-digit decorative growth on YOY basis, that negates the seasonality in the system. But when Asian Paints on the con call has given quite a cautious kind of outlook, and I think that Kansai, the only problem or a plus point, if you see a longer term perspective, is that they have a couple of capacities coming up. So they will be underutilized in the recent quarters. So that might put a pressure on the numbers, because depreciation will move up and the revenues won't move up as they expected. But I think that gives an opportunity for these kind of companies to correct their valuations. So I think hold off for another quarter, see the results, and then dip it.
Okay, that's the view on the paint space. One of the few spaces where the numbers have actually surprised the street. Both Asian Paints and Kansai Nerolac posting good set of numbers despite of slowdowns seen in the industrial segment. We'll wait back for Berger Paints. The stock's up about 6%. Before we thank you, Samir, any idea for our viewers?
So I think checking out, I think Canfin Homes looks good to me in all this noise and wherever the NBFC housing are facing problem. I think the source of funds is not an issue. The loan growth is, I think, consistent and gaining market share in the whole environment. The dispersals are consistent as well. So I feel Canfin can give you another 15 to 20% upside from here itself.
Okay. Canfin Homes there is one of Samir's picks. Didn't do badly in terms of its quarterly numbers as well. Thanks, Samir, for joining us. Appreciate you taking out the time. We're going to slip into a very short break, but before that, UBS's Gautam Chachoria remains cautious on the Indian growth story. Speaking to Bloomberg News, he added that UBS is expecting the Nifty 50 to hit 12,000 by year-end based on 3 factors. Let's listen in to find out what those factors are.
So we have been cautious on India's growth expectations by the street for last 4 years odd, and we still remain. We still think growth expectations are still high, both on GDP as well as earnings. But our 12,000 Nifty target is premised on 3 simple things. One is we do expect the government to acknowledge, like they are over the weekend, the growth slowdown and have measures to give equity markets hope that growth will pick up 2-3 quarters out. And one of the key measures which we are looking at is the capitalization of SOE banks, possibly through the RBI dividend route. The second would be a credible, exciting reforms agenda post the Modi government coming in with a bigger majority, which will get equity investors hopeful for the long-term growth story. And third is a proper policy package which will bring focus back on India's golden opportunity to gain market share in global manufacturing exports as China starts vacating.
This is it, isn't it? And the Make in India policy, many people have given it mixed reviews, haven't they? What's your take on it?
So our sense talking to investors is nearly consensus view that India has missed the manufacturing bus, which we think misplaced based on our bottom-up work as well as using our evidence lab surveys of businesses in China, Taiwan, Korea, Japan and India suggest to us that the investors and businesses are looking at India as much as they are looking at Vietnam, Indonesia, and the inquiries coming into for Indian businesses is also very, very high. More than 85% of them have seen inquiries for FDI or collaborating or manufacturing. And even if you look at data for the $200 billion list of products where US imposed tariffs, post the tariff imposition, India is one of the few countries, 4-5 countries globally, which gained share in these products. So India has the building blocks. We do need a big policy push, and that's what we look forward to.
Gautam, it's Juliet here in Singapore. I just wanted to get back to your call you were saying earlier about being very bullish on the overall market. I understand you've got Nifty 50 rising to 12,000 by year end. You were talking about, some of the areas that you see growth, but where would you stay away in this environment? Stay away from?
So firstly, I won't say we are very bullish, but yeah, 5% upside is definitely possible, premised on those 3 conditions. Having said that, the sectors we would be overweight are the retail liability-driven private banks, oil and gas, property, utilities, and where we would stay away from, for sure, still autos, industrials, infrastructure, mid-caps, and non-bank financials.
Okay, and in terms of, I guess, what we've been seeing in terms of some of the data as well, though, India's private sector has been slowing somewhat. Are you concerned about that?
So yes, at the margin a little bit yes, but from a top-down perspective we have been highlighting that earnings growth will disappointment for the street, and even GDP estimates we have cut recently to 6.7% for fiscal year March 20. So a bit surprised, but that's bound to happen when we still haven't seen enough measures to arrest the growth trajectory we have seen recently.
Gautam, this is it as well. Next Wednesday we have, as Nasreen was telling us, this quite important Reserve Bank decision there taking place. Many people expecting a cut. Is a cut or several interest rate cuts a panacea for the Indian economy? That's the first part of my question. The second part is, could it actually be, in a funny sort of way, bad because household savings and the incentive to save may actually lessen?
Yes, that's a tough spot for policymakers. But firstly, the rate cut itself is not a panacea. But yes, if you see aggressive rate cuts, we're still looking at very, very high real interest rates in the economy, both for businessmen and for households. So if you're talking about another 25 basis point cut, it may not help much. Our own economist expects 75 basis point cuts for the remaining of the year. That could help at the margin. But what is still missing is the transmission of the rate cuts. And a large part of the banking system, the SOE banks, are still undercapitalized. So in our view, an aggressive recap of the banking system through the SOE banks is what could really help drive growth recovery back up.
All right, that's UBS view coming in on Indian markets, and shifting focus back, we're still down about 90 points for Nifty, 11,190, and Bank Nifty is trading around the level of about 29,300. Remember, the outperformance from Bank Nifty is owing to the positive movement we've seen for ICICI Bank, which is a heavy weight, and the brokerages too have given thumbs up post the first quarter earnings. The stock's trading with gains of about 3 to 3.5%. Let's touch base back with Ashish Kelkar. Hi Ashish, hope you can hear us now. What's the view on the individual stocks that you were sharing with us? What's the top picks for this afternoon?
Good Good afternoon once again, and sorry for the inconvenience. Let me go through about two stocks. The first one was Demand. Demand, this particular stock is it was consolidating for the last 4 to 5 trading sessions, and now it is on the verge of giving us a technical breakout, which is a pennant pattern. So I'm expecting a good rally in this particular counter. So I'm suggesting a buy over here. For this buy signal, the stop loss should be at 1440 and my first target would be 1475. Either this target would be achieved today or by tomorrow. So this is the first stock on the long side or where a long position can be taken. And the second stock which I would like to suggest is CESC, where I am suggesting to go short because the chart structure is looking very weak. So currently the cash price of this stock is 735. The stop loss should be 742, which is around 7 rupees, 1% from the current market price above. And the first target which I can see on the chart is 719 rupees.
Okay, there's some stock ideas from Ashish. Ashish, quickly, just a few stocks that I want your reviews on. Today, IT as a pocket is doing okay. And ICICI Bank, on the back of good results, is up about 3.5%. At 430, ICICI Bank, would you go long?
Definitely, the chart structure is looking good. Earlier it was correcting and it has corrected from a level of around 440 to a level of 400, and from there it has started taking a U-turn and currently it is trading at around 430. Today it opened with a huge gap up, so there is a possibility that the price can come down to fill up this gap. But this will be an opportunity to go long further because the overall chart structure is good. The first target which I can see on the chart is around 455 and the second target is 467. So this level is very good level to buy. The strict stop loss should be kept at 419 on a closing basis.
Okay, that's ICICI Bank. A lot of buy recommendations that have been pouring in on that counter. Strong, stable results, and the stock's been rewarded. Let's find out now what's made it to Mishika Parak's list of the Fab 4 stocks for the afternoon. Mishika, good afternoon.
Good afternoon, Devina. The first stock on my list of Fab 4 today, like discussed right now, is ICICI Bank. The stock is gained on the back of very good quarterly numbers. IDFC Securities has hiked target price by 10% to 525 rupees. And they've said this was a solid quarter. And they expect to see a sharp turnaround in earnings going forward. They also expect an ROE of 15% by FY21. Second stock is Astral Polytechnique. The stock is gained as much as 2.3% ahead of results tomorrow. Stock number 3 is Graphite India. The stock is gained for the 5th consecutive trading session with volumes trading double its 20-day average. And last on my list of Fab 4 today is Mahindra Finance. Fresh longs were seen with high open interest of 25.6%. Back to you, Devina.
All right, M&M Financial, that one was the stock that was really beaten out of shape post its results. So some amount of recovery from those lows. 305 now for M&M Financial. Ashish, some of these IT names, tomorrow Tech Mahindra reports its numbers, but ahead of that, there is some interest in not just Tech Mahindra, but Infosys too. 791 now for Infosys. HCL Tech is up about 1.5%. It's breached the 1,000 mark. Would you take a play on any of these?
Yes, definitely. Not Tech Mahindra, but I surely would want to go with TCS because TCS, the overall chart structure is good. Talking about the IT sector, you asked me about the Infosys, HCL Tech or Tech Mahindra, but I would like to go with TCS because the overall chart structure, when I compare all these 4 IT companies, TCS is looking good because every time it has gone up and it has corrected, that if I join all the bottoms made in the recent past, the trend line value is very near to the current market price. So I'm expecting a bounce back in this particular counter. Currently it is trading at 2130 in the cash price. I'm expecting a target of 2240 within next 1.5 week. So this is a positional trade which I am recommending, and the strict stop loss should be kept at 2060 and the first target is 2240.
Okay, so that's a positive call coming in on TCS, which is trading in the positive territory, up about 1%. Let's bring in the next voice on the show. Yogesh Mehta of Yield Maximisers joins us now. Hi Yogesh, good afternoon, and thanks a lot for joining us today on Bloomberg. Quinn, first up, how do you calm investor nerves? Majority of the portfolios are in dread. What are you advising your clients to do?
Yeah, Navneet, good afternoon. The markets are on a turbulent mode right now, and whatever you buy goes down. And maybe there are some extra reasons which are forcing markets, forcing investors and traders to get into getting out of their positions and result is an invested portfolio. Right now, it would be prudent enough if if the investor will sit on cash by 60 to 70%, though markets are correcting and it's a good opportunity. But yet the way earnings are getting delivered by all the sectoral companies, maybe from the Nifty or the Nifty 500 companies, are not so encouraging, barring few which you can count on your fingertips, and the slowdown which has given some caution note from the private sector bank bellwethers of that. So I would say 60 to 70% one should remain on cash, and yes, the markets are on a turbulent, then one has to keep a tab on that, and this is just a part of investment phenomenon.
Yogesh, you're advising to, have cash between 6 to 70%, and when would the time come when you will start advising clients to start deploying cash into the markets then?
Yeah, no, then ideally it would be, see the results, and as I mentioned, it is not turning up, and probably we may see some further slowdown in the Q2 as well, and probably scenario may get changed over post festive seasons. So I would say then it should be only a trading portfolio rather than investment scenarios, because the stocks which are looking good right now, which have delivered strong, good numbers ahead of expectations or in line with expectations, are not available at that attractive valuation. And the companies which are available at attractive valuation, they may not remain at this attractive because the earnings are going down. The denominator factor is showing that ultimately the P is going high. So I would say one should wait for at least one more quarter and one or two for the investment, and for the traders it would be a good opportunity whenever the stock prices falls, like we have seen in Jubilant Food, or maybe today is a Grasim. So probably that may give a good opportunity to get into those stocks for 5 to 10% kind of returns.
Okay, just want to quickly have a look at what Europe is doing as well. You just saw the turnover numbers on your screen, which are picking up a bit, but you've still got 20 minutes left to go. On the cash side, you will see a slightly lower number. Remember, the last few days of the week, you've seen numbers of about 33, 34,000. May not see that in today's session, but the F&O volumes have been at par with average. FTSE is up about 1%. You've got the CAC and the DAX looking weak this afternoon. Dow Futures comes up next. Give you an indication of what you could expect from the US equity markets, and that's absolutely flat. Nothing much is happening out there. Yogesh, one or two stocks that you're pretty convinced about in terms of being a relatively decent bet in a falling market?
Yeah, Devina, then it would be very choosy one. That one would be, of course, has to look at Titan, where the management commentary has given some kind of a caution note, and probably they will grow by a little less than 20% this time. But this is just first quarter ever. They've raised their slowdown impact and the concern over there. But I feel that, again, right now it is a little less than 1,100 rupees. If it comes down further, or high 1,350 odd, and if it comes down to near to 1,000 level or odd, it would be 1,000 to 1,030. It would be a good opportunity to get into that. So I'm just vouching for that. And the other one would be, again, Jubilant Food, where the commentary from the management is quite optimistic, even though in terms of online competition. But yet I feel if with a better expansion in the plans may come into action in next 6 to 9 months, then probably on a high multiple even, the gradual story of the growth remains there. And SSG growth, which is on the high base effect, right now it has come down to 7.5% probably for the entire year I'm talking about. So even if it happens up to that level, probably that would be a good opportunity to get into that.
Okay, those are some ideas coming from Yogesh. One of them is Jubilant Foodworks, which, by the way, is just sitting flat in today's trade despite of markets being lower. Well, the one stock that's been under a lot of pressure today is Vodafone Idea. The company's earnings have disappointed and the stock's trading below its face value for some time now. There are a few mutual funds which have some exposure to the company, and Yash Upadhyay has drawn up a list of mutual fund holdings as on the end of the first quarter. Yash, over to you. Take us through the details.
That's right, Navneet. So, Vodafone Idea has a sizable holding by most of the international as well as domestic mutual funds. Almost 27 or 28% of the overall holding is with the public shareholders, and some large mutual funds, they have their holding. Now, mind you, the stock has been falling for the last 8 trading sessions, and in fact, it is down more than 43%. Of course, down to also the fact that it is down 27% in today's day of trade after coming out with an extremely weak set of numbers. But coming straight to the top mutual fund holdings, and Franklin Templeton holds the highest when it comes to the other Indian AMCs, and they have a total stake of around 2.5%, and they over the previous quarter, that is a March quarter, have added another 1.7 crore shares in the company. Along with that, ICICI Prudential, ICICI Life Insurance Company, SBI Fund Management are some of the other big holders in the company, holding anywhere between 2% to over 0.5% stake in the company. They have across the different schemes managed to bring their holding down in Vodafone Idea, but they had also across the different schemes that they have had subscribed to the rights issue which came out earlier in the quarter. So do keep that in mind. Along with that, Aditya Birla Sun Life, Kotak Mahindra AMC are some of the other prominent names that do have a sizable holding, but most of these mutual funds they have taken a hit on account of the fall that has been seen in Vodafone Idea shares. As you rightly mentioned, they are quoting below their face value at the current market price as well. So these are the names that you need to watch out for.
All right, Yash, thanks very much for digging into that and getting us those investors in Vodafone Idea. But it's also now time to take a look at what dealing rooms are recommending, and Yatin Mota joins in right now with his channel checks. Yatin, good afternoon.
Good afternoon, Devina. And Grasim, that stock is in focus. It's down 8%. Obviously, few moments back, Yash was talking about Vodafone Idea, 28% cut coming in. In general, the markets have been talking about debt concerns, and on the back of that, institutional selling in most of these Birla Group companies. Probably the commitment towards telecom in terms of further investments, group consolidated debt is something which investors are worried at about this point in time. 9% down for that one, and dealers do expect further downside as far as this name is concerned. Apart from the Grasim, the next stock that we are talking about is Maruti Suzuki in the auto pack. Dealers in general have been talking about as to how FIIs are sellers on the aggressive side as far as autos are concerned. Bajaj Auto is down 4.5%, 5%. Maruti is down 4.5%. So clearly the disappointment in terms of government action and earnings both playing their roles as far as the fall in auto sector is concerned for trade today. So dealers expect further downside in auto stocks. The only stock which is holding out, and probably the Nifty versus Nifty Bank today, you could see a clear trend of Nifty Bank outperforming the markets at this point in time. In the PSU Bank space, we have PNB, which is doing well. Dealers on the basis of F&O trends are recommending a buy today, sell tomorrow kind of a strategy.
All right, Yatin, thanks very much for that. Hemen, Punjab National Bank holding out in a falling market. Would you buy that stock?
PNB in a falling market? No.
No. Anything else within that pocket?
No, I'd probably sell a Cipla or a PVR, but I wouldn't buy anything because I think we could decline a bit tomorrow morning before we sort of turn.
Okay. Ashish, anything in the last half an hour that has caught your attention? Tata Motors, for one, is down about 6.5% now. It doesn't seem to have a bottom currently. Would you sell it further?
I won't be selling Tata Motors, but there is another stock which is on my radar, and that is ONGC. Because ONGC, this stock, it was making lower top and lower bottom. It has recovered from that bottom, and now it is a fresh opportunity to go short. So currently it is trading at around 141 in the cash market. My stop loss would be 143.5. My first target would be 138 and the second target would be 136.5.
Okay, and ONGC, by the way, is off today's low right now. It's sitting with not seeing any gains, but it's off the day's low around the levels of 141. The other one, which is doing well in a weak market like today's, is Hemen Financial. Pull up that stock. It's up about closer to 3%, but not to forget, it's a beaten down counter. Last week, it fell about 17%, Hemen. But would you take a bet here, or is it just a short covering bounce?
Yeah, but I think it's a risk worth taking because the market's also pretty oversold. We're at 305, so closer to 304, 3 rupees stop loss, 6 rupee target. Yeah, BTST possible and playing for a small bounce, Navneet.
Okay, just 10 minutes to go for markets to shut shop. So let's get you some more closing strategies from our technical experts. Ashish, let me come to you. Any BTST or any STBT for tomorrow's trade?
Yes, definitely. My stock for BTST or STBT would be Century Textile. It is poised at a very important level, 882. So within next 5 to 7 minutes, if it goes below 880, then I will definitely go short in this particular counter, because my next target on the chart is around 861, which is around 22 rupees from here, and the second target would be 845. So I will keep a watch on this particular counter. If it goes below 880 in the cash price, I will go short and I will carry forward the position for the next day. And my stop loss would be 902 for this particular stock.
Okay, so around 880 or below that is what Ashish is advising to go short on this stock, that's Century Textiles. Hemen, what about you?
Well, it's a toss-up between a BTST on Hemen Finance and a sell on PVR. I'll go with a BTST on Hemen Finance. 304, stop loss 301, target 310.
Okay, so he's going with the same BTST he just shared with us. That's Hemen's buy call on Hemen Financial at 305. Yogesh, I know you've discussed your ideas in Jubilant Foodworks and a couple of other stocks, but can't let you go without taking your views in the auto pack, which has been in focus and underperformance seen for the second straight year now. I was just checking the data. Last year, the Nifty Auto Index was down somewhere about 23%, and this year also it's down almost 25%. If there is a valuation comfort that you're seeing, which stock would you pick at current levels?
No need to be very frank. For the auto, I had multiple times in my conversation with your channel, I have mentioned that auto will be in a slow lane for quite a long time. And even with the disruption which is coming now, BS6 norms, and then the now EV disruption. So all these will have some headwinds, and the capex cycle for all these passenger vehicle companies particularly, and the slowdown in economy which is visible in terms of new sales and in the new sales at least, but it is not showing in terms of GDP right now. But I would say two-wheelers, four-wheelers, and the four-wheelers all together will have some more challenges and uphill tasks for their upward momentum. And this is not going to be resolved in near future and very soon. On the valuation front, as I mentioned, the denominator factor is getting unfavorable. So even if we consider that Maruti is available at around 220 to 225 rupees EPS, and it will be still 24 times, but you don't have any other option than to be into this leader of the sector, because 50 to 53% market share for the passenger vehicle sector. But I would say auto sector for some more time one should avoid that. Rather than that, IT would be one where I would see that the leader of the sector like TCS and the Infosys and maybe a Tech Mahindra, which is coming out with the results tomorrow. So that needs to be watched out, and post the management commentary, one can take a call on that. But IT I would prefer more in defensive way rather than auto, because valuation comfort are prima facie right now is attractive, but ongoing after one or more quarter more, it would be expensive again.
Okay. Dr. Reddy's reports numbers today. What do you anticipate from it?
For Dr. Reddy, I think it would be a flattish kind of a growth, 7.5% kind of a revenue. But more commentary would be I would be watching out for where Copaxon and Suboxon both are how the company is going to plan for that launch and the sales number. Though Europe is doing well this time, so this quarterly number would be more because of the 7.5%, and the domestic growth would be 8%. So I would say numbers would be in line with the expectation, but the valuation-wise, at 2,650 or 2,700 odd levels right now, it leaves very limited room for upside and for the investors.
Okay, Yogesh, we'll leave it at that note. Thanks a lot for joining us today and sharing your thoughts on the markets with us. Well, no respite, we're still below the mark of 11,200. Ashish, are there any interesting trends that you're spotting right now? Anything you want to share?
Yes, I have one stock, Indiabulls Finance. As of now, go short immediately. Tomorrow morning, if we have a gap down, then cover immediately is the recommendation. Tomorrow, keep a stop loss of 562 and the first target on the chart would be 535.
I mean, what about Kansai Nerolac? We just, I mean, the stock is up on back of good set of numbers, but if somebody's bought the stock, do you expect more upside here?
I think so. Maybe it's being a defensive, maybe Bharuka, Kansai. They seem to be stable enough now, so at least as of now, it seems okay.
Ashish, you had some views on IT. Would you like to share that?
Yes. Infosys is my second choice. Earlier I have shared my the first interest is TCS. The second is Infosys, but Infosys I'll wait and I'll buy only above 803 because that will be a breakout of pennant pattern formation and the target would be 835. The second target would be 843. My stop loss will be 785.
Okay, that's the technical call on Infosys. Just want to pull up Chennai Petro. I think the stock's seen some bit of gyration on back of the earnings. It's sitting with gains of about 6 to 6.4% right now around the levels of 206. Very quickly, Hemen, on the charts, is there any trend with the current move?
Maybe a small 4-5 rupee move to 20211. I think 20150 is support. So, yeah, I think even ONGC, despite what is happening, I think the petroleum pack is just a wee bit oversold, so maybe some resilience coming in.
Okay, that's about Chennai Petroleum. Keep an eye on that one. The stock's just moved in the last 15 to 20 minutes of trade. Besides that, just want to highlight a few stocks from the broader markets. You've got something like Skipper, which is nearing the territory of upper circuit. It's up about 19%. And Tejas Network, remember the numbers were not good. We did see sell-off, but in today's session, there is some bit of bounce back that has come in for Tejas Network. But just about 3 minutes to go for markets to shut shop. Let's go across to Davina to find out how exactly the closing today is panning out, Davina.
And not a good one, Navneet. We've got a dip of about 91 odd points on the Nifty. Most likely, if nothing changes in the next 2 minutes, you're going to see a close below 11,200. That was yet another psychological mark for the markets. The 200-day moving average level for the index, I think, falls somewhere closer to about 11,127. That's going to be the next hurdle to break on the downside. And if that gets taken down, then it could leave a bigger downside hole open. But on the Sensex, we're down about 187 points. The Nifty Bank too. So Nifty Bank is actually not done all that badly. You did have HDFC Twins bearing down a little bit more as we started the show, but then I think they're going to close with losses of just under 1%. So that's the Nifty Bank, which is holding above the 29,300 mark. Coming to individual movers then, and starting off with the gainers, far and few, but still you've got some of them. ICICI Bank didn't disappoint the street with its numbers, and therefore the big thumbs up, 3% higher on ICICI Bank, and this seems to be a consensus call on the buy side with levels of about 460, brokerage targets of about 560 as well on the stock. IndusInd Bank, that's up about 1%. HCL Technologies and IT as a pocket seems to be the defensive bet in today's session. So Infosys, Tech Mahindra, TCS, all doing well. Britannia too, marginally higher. Amongst the bigger losers, Indiabulls Housing, that's the biggest cut that you've seen, and it's not just housing, but the entire group has lost out in today's session. 9% down for Grasim on the back of Vodafone Idea losing 30%. I think Namit will highlight that for you. But Tata Motors down 6.5%. You've got a 5% cut on Vedanta. 2 straight days of losses. I think it tallies up to about 10% in 2 days for Vedanta. Bharti Infratel, that's down 5%. Eicher Motors and the rest of the auto pack all witnessing a lot of pain. Z finally succumbs to some amount of pressure. I think it's taken it down under 400, which it had surpassed in Friday's session. UPL also down about 2.6%. But the broader market space, probably a little more pain.
That's right, Davina. There was selling seen across the board on day one of this fresh week. So clearly no respite coming in for Indian markets. I'll still start off with a couple of gainers. ICICI Lombard, that one saw some bit of buying in today's trade, and that stock's closing with gains of about 2 to 2.5%. Hemen Financial, this was down 17% last week, and the stock's been falling for the last 3 weeks. So probably today's move was maybe on account of short covering, but still in a weak market, it managed to close in the green, 2 to 2.5% higher. Watch out for Marico. This one will be coming out with the numbers this week, and ahead of that you were seeing some bit of positive trade in today's session. And Skipper, which we just highlighted for you a while back, there was some buying interest coming by for this small cap company, up about 15%, and the move came in just in last hour of trade. And Kansai Nerolac came up with the numbers, and in line with what Asian Paints posted, especially with regard to the decorative segment, where high double-digit volume growth was seen, and positive commentary coming in with regard to that volume growth, 7% higher for Kansai Nerolac. On the losing side, Idea disappointed. The street was disappointed with the numbers. No respite. It's become a penny stock below the face value, now trading at 6.7, 26% lower for this one. Havells, across the board, there was a miss, be it top line, bottom line, margins. The numbers were not at all great, I think, because of the Lloyd business. A lot of fresh short positions were seen here. Arvind, also one of the F&O stocks which saw selling pressure in today's trade. It was down some at about 11 to 12%. That's the closing is coming almost at day's low level. And Apollo Tyres, this one touched its 52-week low in today's session. Aggressive selling seen here as well. Besides that, you had BEL, another F&O stock which saw some fresh shots building up in today's trade. And we were talking about Vedanta. So you also had Hindustan Zinc, which fell in today's trade. So some selling pressure coming for the other companies of the same group. Hindustan Zinc was down. Lakshmi Vilas Bank and Indiabulls Ventures, despite a clarification coming in from the Indiabulls group, but the stocks continue to fall. Lakshmi Vilas Bank was locked in lower circuit, down 10%. By the way, that was just a rub-off impact on Lakshmi Vilas, but for the group, Indiabulls Ventures, Indiabulls Housing, and all the other stocks were under pressure, 5% lower here.
All right, so a lot of pain there across the board in the broader market space. You finally got a closing tally of sub 11,200 on the Nifty. Banks have done okay. They've managed to just about stay afloat. 21 points down. Nifty 50 at 11,192. The key contributors, you can't blame the banks today. You got losses coming in, though from HDFC Bank, where you still have that. But auto as a pocket looked weak, and Grasim taking that big, huge 8.5% knock today contributed, along with ITC, which was down about 6 odd points. Gains came in from the safer haven names of banks like ICICI Bank, IndusInd Bank did well, and IT as a pocket stood out in today's session.
Okay, and talking about the broader markets, the breadth continues to be weak, and that's the advanced decline ratio. The gap was only widening throughout the session. As you can see, almost the ratio was 1:3 in favor of the declines. And talking about how the participation panned out on day 2 of the new series, you had the NSE F&O turnover just about closer to 9 lakh crore, and on the cash side for NSE, 30.438 crore.
All right, that's the closing for today. Let's get in some closing thoughts and ideas on how to step into trade tomorrow. Ashish, your closing thoughts?
Again, tomorrow I'll watch for the Century Textile, which I have already told you. It has not closed below 880. But tomorrow, if it opens below 880, then definitely I will go short, because the targets are very big on this particular counter. So Century Textile would be the stock which I'll watch out for.
Hemen, what about you?
I think the markets are light, Devina. Very apparently weak, but we're oversold. So I would be slightly careful. Obviously, weak pockets would. I have a feeling the next couple of days we should be seeing a small bottom and a dead cat bounce coming in, simply because we're too light on the F&O segment to warrant another decline, significant decline after the 600-point decline that we've seen, Devina.
All right. Thank you so much, Ashish and Hemen. Really appreciate both of you taking out the time this afternoon. And on that note, it's a goodbye from Navneet, myself, and the entire team that's put this show together. Thanks so much for watching, and do watch out for the Dr. Reddy's numbers that are expected anytime.